all want to perform better in school, at work, with our money. But better than whom or what? Remember in school, your parents always wanted you to get grades as good as this other kid, Raj, in your class. He was super smart and had everything together, but you hated being compared to that kid. If you're Indian or Asian in general, you very well know what I'm talking about. It's the same story with your investments, with a twist. If you're going to spend time analyzing the market and picking stocks, you want to know if the investment is worth your time. You want to know if the investment performed better. Better than whom? That's where the twist is. Better than not the Raj of investments, just the average Joe of investments. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. And I've helped dozens of women take control of their financial futures. Subscribe to my YouTube channel and follow my Facebook page to watch all my latest videos on building your own wealth through investing. Let me introduce you to the average Joe of investments, the broad market index. An index is a collection of various stocks to represent a group. If you asked me, how is the US market doing today? How would you like it if I start telling you the price change since yesterday's close of every stock trading in the United States? Apple is trading at 0.33% below yesterday's close. Tesla is trading 0.15% above yesterday's close. It will take me hours to describe where each stock is trading. And by the time I finish, two things will have happened. One, the price of the first stock I started with has moved a lot from the time I gave you the information at first. So I have to start narrating the price movements again. And number two, you've lost all interest in investing. A broad market index is a combination of stocks. An example is the S&P 500, and it includes 500 largest companies traded on US exchanges. How do you determine which are the largest companies? If you remember what I talked about in my previous video, you will immediately say that I should use the market cap or the market capitalization. But it's not the total market cap that we will consider. The calculation uses free float market cap. Free float market capitalization is calculated by multiplying the current stock price by the number of free floating shares instead of all the shares. So, a company may authorize a certain number of shares and not issue all of them. Out of the ones that it issues, some are restricted. These are the shares that are held by company insiders, so founders or employees, and may be locked based on the vesting schedule. So these are shares that are not traded. These shares are excluded from the number of issued shares in the calculation of the free float market cap. So coming back to the S&P 500, why only 500 companies? Why not all the thousands of public companies? Because you don't have to look at all the companies. If you add the market capitalizations of the largest 500 companies, it equals more than 80% of the market caps of all US public companies. Again, largest by free float market capitalization. That 500 company group is a good enough representation of the entire market. These 500 companies represent 11 broad sectors that we discussed in my previous video: technology, healthcare, financials, real estate, energy, materials, consumer discretionary, industrials, utilities, consumer staples, and communications. So S&P 500 is a value weighted index, which I'm going to discuss in a little bit. To be part of the S&P 500, the company needs to have a market cap of at least $6.1 billion. To compute the index value at any given date, S&P 500 adds the free float market cap of the largest 500 companies, which can be in trillions of dollars. To bring this number to a more manageable value, S&P then divides the number by a divisor. So let me show you how this is done with a 3-stock example. Let's say there are 3 stocks in a value weighted index that we launched on December 31st, 2021. Here's the information for those 3 stocks on launch date. Stock A was trading at $10 a share and had 1 million free floating shares, making its market cap equal to $10 million. Stock B was trading at $5 with 7 million free floating shares, making its market value $35 million. And stock C was trading at $20 and had 2 million free floating shares, making its market value $40 million. The total market value of this index would then become the sum of the market values, 10 plus 35 plus 40, which equals $85 million. That would make the weight of stock A at 10 million divided by 85 million, or 11.8%. Weight of stock B is 35 million divided by 85 million, or 41.2%, and weight of stock C would be 47.1%. Note how the stock with the highest market cap has the highest weight in the index. Now, because we are the owners of this index, we can choose what the value of this index starts at. We can choose to start the index at 85 million, or we can instead pick a more manageable value like 100 or 10. Let's say we chose 100 as the index value on launch date. This value of 100 translates to a market value of $85 million. Note, I said 100, not $100. The index number has no units. The stock with the highest weight in the index will have the highest impact on the index. So let's see what this means with 2 hypothetical cases. In the first case, stock A, which has the lowest weight in the index, has a 20% increase in price, and other stocks stay at the same price on the next day after our index launch. This will cause the market value of stock A to go up to $12 million, with others remaining where they were. So the index's market value will now be $87 million. That's a 2.4% increase in the total market value. The new index value will then be 100 times 87 divided by 85. Simple math, right? 85 million corresponds to an index value of 100. So 87 million will correspond to 87 multiplied by 100 divided by 85, which is 102. Now let's say in the second hypothetical case, stock C, which had the highest weight at index launch, had a price increase of 20%. In this case, the market value of stock C went up from $40 million to $48 million, causing the index market value to go up from 85 to $93 million. That's 9.4% increase. The index value then becomes 93 multiplied by 100 divided by 85, which is 109. Do you see how even though both stocks A and C experienced the same percentage increase in price, the index experienced a greater impact because of the change in stock C? This is because it has a higher weight in the index because of its higher market cap at launch date. You can also see how stock C, which started at a weight of 47%, now has an even higher weight of 55% in the index. So this is the gist of how the S&P 500 index is calculated and how each stock in the index is weighted. So this index was launched in 1957, and I think it started at 10, or it may have been 100. I'm not really sure. Now it is at somewhere around 3,500. You can see how far we've come. Apple is the highest weighted stock at almost 7% of the index. It may have started as a smaller piece when it was first included in the index, and now it is at the top. And another company may come along and take the top place. Who knows? This is how a value weighted index is calculated. There are other types of indices or indexes. You may have heard of the Dow Jones Industrial Average or the DJIA. The DJIA is a price weighted index. It is a different kind of weighting. So instead of market cap, this type of index uses stock prices to calculate the weights. If you want to learn about how price weighted indices are calculated, let me know in the comments. The DJIA includes the largest 30 industrial stocks, also called blue chips. It is a very small subset of the thousands of companies in the United States. These are more stable, mature companies and maybe less volatile than your typical company. The term blue chip comes from poker, where they use different colored chips to represent different dollar amounts. And apparently blue chips have the highest value. So these companies supposedly have the highest value. I don't play poker, so don't ask me about the other colored chips. I don't want to misinform you. Similar to how we created a hypothetical index of 3 stocks, there are many index providers, Standard & Poor or S&P, Dow Jones, Russell, MSCI, and so on. The formulas for some of them are not as simple. Some use very complicated formulas. These companies create many different types of indices and sell this data to users of these indices. They have their own criteria on inclusion and exclusion of specific stocks in the index. Some may say, for example, I will not include any stock that trades below $2 for more than a month. Just an example. They may have a review schedule on which they make decisions about including a new stock or excluding a current stock from the index. I have included a link to the S&P methodology in the description. If you're interested in a deeper dive, take a look. Now that you know what an index is and how it is calculated, let's see why we need an index. A broad market index is your average Joe of investments. An obvious use of an index is to create an indexed portfolio, which is your average passive portfolio. It's like going to an index provider and asking them for weights of stocks in the index. And let's say you have $100,000 in your portfolio. Then you go to your brokerage account, buy the exact same stocks that are in the index in the exact same proportion as they are in the index. And you go to sleep or you go about your day. This is passive investing because you're not actively investing in specific stocks. You're not worried about picking stocks that will outperform the index. Index fund providers such as Vanguard or Fidelity create index funds that you can directly invest in instead of doing this exercise yourself. And they charge very little compared to how much it would cost you to implement this passive portfolio. Quick quiz. If a new stock is included in the S&P 500, what do you think happens to its price immediately? And I'm going to give you the answer, but I want you to pause and think for a minute. Okay, your time's up. Because there are so many passive funds or indexed funds that are replicating the S&P 500, they will immediately buy this new stock because they have to include it in the portfolio because they are mimicking the index. What happens when there is a sudden demand for that stock? The price goes up. It may normalize later, but the news of inclusion of a new stock almost always leads to a price increase. The opposite happens when an index decides to drop a stock from the index. The second use of an index is to gauge the overall economy. And we touched upon it earlier. A broad market index like the S&P 500 includes more than 80% of the US market, US equity market. So it's a good representation of the overall market. So just by looking at it today, I can say how the market is doing and what the public sentiment is. If the index falls by say 20% over a year, I can say that the market sentiment has not been good. Then I can do my own analysis and decide if it's the right time to double down on investing because I think the market is going to turn, or to expect more tears and bloodshed. Now that you know what a market index is, it's time for an assignment. Go to Yahoo Finance and find out what the US market is doing today and share that in the comments below. Also find out what the broad market has done so far. You can use the S&P 500 index if you like. If you want to look at other country indices, I will list them in the description below. It'll be linked. The third use of an index is its use as a benchmark. Is your portfolio the Raj of portfolios, or is it a Joe, or is it worse than Joe, like a Chris Brown of portfolios? If your portfolio is performing worse than the index, maybe you're better off indexing your portfolio instead of managing it actively. If your portfolio is performing better than the index, you may be a good investor. And I say maybe because you have to look at performance, not on its own, but on a risk-adjusted relative basis. In my previous video, I talked about beta, if you remember. That is one measure of risk. If your portfolio had only tech stocks during the tech rally, your portfolio would have outperformed the S&P 500, but it may have been at a higher beta than the market. It would have been more volatile. So when the tides turn, your portfolio may not have done as well as the index did. If you have a financial advisor, pay attention to performance, not just relative performance, but risk-adjusted performance. Without going into specifics, here are a few measures you should look at. 1, beta, which I already talked about in my last video. 2, alpha. This number should not be negative over the long run, say 5 years or 10 years, etc. 3 is sigma or volatility. Compare the volatility of your portfolio with that of the benchmark. 4, information ratio. This number should not be negative over the long run. And 5, Sharpe ratio. Again, this number should preferably not be negative over the long run. There are many other measures to look at, but these are the basics. If you are interested in learning more about these measures, you know what to do. Look at these measures over the long run. Financial advisors or even funds may try to manipulate you into thinking that they are doing a better job than the average market by showing these numbers over favorable periods. Choosing the right benchmark is important too. If you have only crypto currencies in your portfolio, you don't want to compare your portfolio against the S&P 500 or a bond index, because one is not a representation of the other. If you're retired and have a chunk of investments in bond funds, you need to include a bond index as part of your benchmark. Your benchmark needs to be a composite of both stock and bond indices. Here's another assignment. If you have an existing portfolio, go check your holdings and determine the appropriate benchmark for your portfolio. Now that you know what an index is and how to select a benchmark, I want to introduce you to technical and fundamental analysis. But before that, if you like what you've heard so far, please smash that like button. You'd be doing me a big favor. And if you haven't already, please hit the subscribe button and click on the bell icon to get access to my latest videos. If you're watching me on Facebook, don't forget to follow my page, and please comment below about what you like and if there's something that you don't like and what you want to hear more about in my future videos. I have also linked my budgeting worksheet and my personal investment plan template to help you create your own investment plan. And here's a video that explains how you can build your own investment plan. And remember, everyone should have an investment plan in place. Now let's get to fundamental analysis. Look at this Louis Vuitton bag. What's the value of this bag? Look closely. It's priced at $27.20, but what is its value? If all things are equal, just by owning this $3,000 bag is going to make you happy, and the happiness is worth more than what you pay for the bag, the value of the bag is higher than the price. If, however, the bag brings no joy or adds no value to the quality of your life, then its value is lower than its price, much lower. Now, I had a friend whose business involved working with high-end clients. She is still my friend, by the way. She thought that the perception of appearing wealthy brought her a lot more business than she otherwise would have. So, for her, the value of high-end designer bags and jewelry was higher than the price she paid for those items. Price is what you pay, value is what you get. Anytime you make a buying decision, think about this. What's the price of this item I want to buy, and what's the value I'm getting out of it? It'll make your decisions easy. Let's apply the same principle to investing. When you make an investment in a stock, you buy that stock at a specific price at which it is trading, with the expectation that you will earn a positive return when you sell it. So the value of the stock needs to be higher than the price at which you buy it. How high? That would depend on your required rate of return. How much return do you want from that investment? The value in the investing world is known as intrinsic value. Fundamental analysis is the process of determining this intrinsic value. I'm going to explain this one more time. So, price of a stock is visible. You go to Yahoo Finance or you go to your brokerage account, enter the ticker, you can see the price. Very similar to how you can see the price of the Louis Vuitton bag I just showed you. It is what the stock is trading at, depending on demand and supply of its shares. If you want to buy the stock, price is the amount you would pay. Value, on the other hand, or the intrinsic value, is invisible. You need to calculate this invisible intrinsic value. If the price is below the intrinsic value, the stock is being undervalued by the market, which means you can buy the stock at its current market price and sell it when the price of the stock reaches its intrinsic value. If the price is above its intrinsic value, the stock is overvalued, which means you should sell the stock if you already own it, or you don't buy the stock, or you can sell the stock short and buy it back when it reaches its intrinsic value. I had talked about short selling in this video, where I also talked about risks of short selling. If the stock's price is exactly equal to its intrinsic value, you can sell the stock if you own it because it has reached its intrinsic value. Or if you don't own it, you do nothing. The process of calculating this intrinsic value is called fundamental analysis. When you do fundamental analysis, you look at a number of factors that may be specific to the company, the industry in which it is operating, and the overall economy. Using that analysis, you arrive at the stock's intrinsic value and hope that the overall market realizes this stock's intrinsic value over time, and demand-supply dynamics push the stock to start trading at its intrinsic value. What if the stock does not reach its intrinsic value? That's the risk you as the investor takes, which is why you need to have a required rate of return for that level of risk. Let me explain this with an example. Let's say a stock is trading at $100. I do my fundamental analysis and determine that the intrinsic value for this stock is 110. It should trade at 110. My required rate of return is 15%. Should I buy this stock? Based on my required rate of return, the intrinsic value of the stock should be at least $115. Why? Because if I buy it at 100, it has to reach at least 115 before I make my 15%. My calculated intrinsic value is 110, which means I don't buy the stock even if it is trading below its intrinsic value. Instead, I look for other investment opportunities. There are a couple of ways to calculate your required rate of return, which I'm not going to go into detail here. But here's how to think about this rate. Let's say you have only $100 to invest. When you invest in this one stock, you are foregoing all other opportunities to invest. What is the highest level of return you can get by investing in an asset with a similar risk as this one. That's your opportunity cost of investing in this asset, or your required rate of return. There are many facets to fundamental analysis. You can broadly categorize it into two types: top-down analysis and bottom-up analysis. There is no right or wrong way. In top-down investing, you would start at the macro level. Start with the analysis of economic conditions and determine the allocation between stocks, bonds, cash, and other assets. Then you go one step down to industry analysis. Determine which industries would prosper. And finally, you would hone in on the most undervalued companies within the best industries. Bottom-up analysis focuses on companies first, analyzing financial statements, earnings growth, and financial ratios. We had briefly looked at one financial ratio, the PE ratio, in the previous video. The PE ratio is just one example of a valuation ratio. It measures the price of a stock relative to its earnings to see if the current price of the stock is justified given its level of earnings. Let's look at two hypothetical companies, A and B, operating in the same industry. Let's say stock A is priced at $20 and B is priced at $15. Which one is cheaper? Can you tell? Not just by the share price, right? Remember, a company can have many shares. It can undergo splits, reverse splits. So share prices on their own are not comparable. Now let's say stock A has an EPS of $1 and stock B has an EPS of 50 cents. What is EPS? We talked about that last week. Earnings per share. That's the net profit per share. Now with this additional information, can you determine which stock is cheaper? Now that we know the price and we know the EPS, we can calculate the PE ratio, which is price divided by EPS. Stock A's PE would be 20 divided by 1, which is 20. P ratio of B is 15 divided by 0.5, which is 30. Now you can say that when compared on an EPS basis, stock B is priced higher than stock A. So stock A is cheaper. There may be a reason for this difference in valuation of the two stocks, and you'll have to conduct a deeper fundamental analysis. Maybe you have looked at the EPS from the last 12 months instead of the forward EPS. Remember TTM, trailing 12 months? Fundamental analysis is much more advanced than this basics of stock market for beginners course can offer. I'm working on a fundamental analysis course which is coming out soon. Keep an eye out for it. But I hope you got the idea of what fundamental analysis is all about. It's all about finding the intrinsic value of an asset. And this intrinsic value may be different from the asset's market price, which you can see. Depending on the comparison between the two, you can then make an informed investment decision. Let's move over to technical analysis. This is in stark contrast with fundamental analysis. In fundamental analysis, you do a deep dive into the economy, the industry, and the company to make investment decisions. In technical analysis, you look at trends in price and volume of trading. Past data is used to make predictions about market behavior in the future. Some tools in technical analysis involve moving average lines, support and resistance lines, trend lines, and so on. Again, similar to fundamental analysis, I will soon have a technical analysis course for you, so stay tuned. Next video is going to be the last video in this series on stock market for beginners. I will discuss market crashes, biases, and how you can open a brokerage account and start investing. As always, don't forget to be happy, to be kind, and to be your best self. Bye. And in case you missed it, go watch the first video of my course on stock market for beginners.